What differentiates an S-corporation from a C-corporation? Choosing the right business structure is a pivotal decision for any entrepreneur, as it dictates how the entity is taxed and governed. While both S-corporations and C-corporations offer limited liability protection to their owners, they diverge significantly in their tax treatment and ownership flexibility. Understanding these nuances is essential for long-term financial planning and operational scalability. This analysis explores the core differences, focusing on taxation, ownership limits, and administrative requirements. The primary distinction between the two entities lies in their federal income tax treatment under the Internal Revenue Code. A C-corporation is considered a separate legal and taxable entity, which often leads to what is known as double taxation. In this scenario, the corporation pays taxes on its earnings at the corporate level, and shareholders pay taxes again on dividends received. Conversely, an S-corporation is a pass-through entity, meaning the business itself does not pay federal income tax. Instead, the company's profits and losses are passed directly to the shareholders' personal tax returns, effectively avoiding the double taxation trap. Ownership, eligibility, and restrictions also serve as a major dividing line between these two structures. C-corporations offer the highest degree of flexibility, allowing for an unlimited number of shareholders, including other corporations, partnerships, and foreign investors. This makes the C-Corp the preferred choice for companies planning to go public or seek venture capital. On the other hand, the IRS imposes strict limitations on S-corporations to ensure they remain small business focused. An S-Corp is limited to 100 shareholders, all of whom must be U.S. citizens or residents, and it cannot be owned by other business entities. Capital structure and the types of stock issued further differentiate these business models. C-corporations are permitted to issue multiple classes of stock, such as preferred and common shares, which allows for complex tiers of voting rights and dividend preferences. This versatility is highly attractive to institutional investors who may want priority in liquidation or specific voting powers. S-corporations are strictly limited to one class of stock, meaning every share must carry the same economic rights. Although they can have voting and non-voting shares, the underlying financial interests must remain identical across all shareholders. The administrative burden and long-term compliance requirements can vary depending on the chosen structure. Both entities must adhere to formal corporate formalities, such as adopting bylaws, holding annual meetings, and maintaining minutes. However, C-corporations often face more complex filing requirements, especially if they operate in multiple states or have international investors. S-corporations must be vigilant about maintaining their eligibility status, as a single prohibited shareholder or an accidental issuance of a second class of stock can lead to the immediate loss of S-Corp status. This terminating event would force the company to be taxed as a C-Corp, often resulting in significant tax penalties. Ultimately, the choice between an S-Corp and a C-Corp depends on the company's growth trajectory and exit strategy. Businesses that intend to reinvest their profits and scale rapidly for an acquisition or an IPO generally find the C-Corp structure more advantageous despite the potential for double taxation. Smaller, closely held businesses that plan to distribute most of their earnings to owners often prefer the S-Corp for its tax efficiency. By weighing the benefits of pass-through taxation against the need for diverse investment and multiple stock classes, founders can select the framework that best supports their vision. We welcome you to subscribe to our YouTube channel for more informative videos on corporations and business. Thank you.